Today, we're going to talk about how to pay off your mortgage. 5 ways to pay less, finish your mortgage off early, save that money, and be financially more stable. Stay tuned. Number 1, so easy a caveman could do it. All right, welcome to the channel. I'm Zach Walker, your Texas local lender. Today, we're going to talk about 5 ways to pay off your mortgage that you may not have heard of, that are going to save you money, they're going to save you interest, they're going to put money back in your pocket, and most importantly, they're going to help you get debt-free faster, which should be the goal of every single human being. The question is, why would you want to pay off your mortgage early? The answer is, you might not. On average, Americans stay in their house 13 years, so not long enough to pay off a 30-year note. So if that's your case, you may not want to pay your mortgage off early. You may want to capitalize on the equity, take that equity and withdraw it when you sell and move to a new house. But when you hit that forever home, you want to get out from underneath that payment as soon as possible, because 30 years of interest adds up very quickly, and you end up paying significantly more over the life of the loan than if you had done it in 20 years or 15 years or whatever term you're able to do it in. So now that we know why you want to pay off your mortgage early and who wants to pay off their mortgage early, let's figure out how. Let's start with number 5. Number 5 is the easiest, and that's simply to make additional interest payments. Loans issued after 2014 typically do not have a prepayment penalty. This means you can make additional principal payments on a monthly basis or whenever you're able to significantly decrease the amount of money you pay and pay off your loan faster. So typically, if you pay your mortgage on the 1st or the 15th or whatever day you pay it on, that payment that you send off or auto draft or whatever it is an interest and principal payment. Some of you may have private mortgage insurance that factors into that, but that payment you make goes both to interest and to principal, and typically the breakdown is not favorable for you. So if you're making a $1,500 payment, it could be that only $750 or $800 is going to principal. The other $750 is going to interest or private mortgage insurance. So by taking an additional payment every month and paying off just principal, you're applying that money directly to the principal alone and not interest and PMI. Now you might say, I don't have the money to do that or make those additional payments. Sure, I completely understand. But if you get a tax refund or you get a bonus at work or you just drink too much Starbucks every month and you decide you want to become debt free, we always find ways to make money for what's important to us. So if this is important, making an additional principal payment every month will significantly help in that journey. Let me just give you a for instance. On a $300,000 house with a 4% interest rate, which is pretty reasonable given current market conditions, that is a principal and interest payment of $1,371. 360 payments times $1,370 means you will have paid $492,500 over the life of the loan. That means you will have spent $192,500 in interest alone. By making those principal-only payments, you can significantly reduce the time, thus reducing the interest that you pay on that loan. If you're able to make simply $250 a month principal-only payments throughout the life of the loan, you're going to end up saving over $52,000 in interest and be debt-free significantly faster. Let's move to number 4. Number 4 is making an additional mortgage payment every single year. Now, this is much easier than you would imagine. What we're going to do is we're going to take our mortgage, we're going to split it in half, we're going to make bi-weekly payments, right? So you're going to pay your mortgage provider every 2 weeks instead of every month. What that's going to do is that's going to create one additional payment every year by simply dividing the same amount of money and spreading it out over a bi-weekly pay schedule. You could also simply just make a 13th payment every year, which would make the same thing happen, but be much simpler to do. Also, it's important to know that mortgage servicing companies may be thrown off by your irregular 2-week payments. You must talk to your mortgage servicer before starting on a bi-weekly payment plan. Number 3 is not a very well-known method, but is certainly possible, and it's called recasting your mortgage. Mortgage recasting is very different than mortgage refinancing, which we'll talk about shortly, because you get to keep your existing loan terms, meaning you get to keep the same interest rate and the same loan payments that you currently have. You just simply recast your loan. In order to recast your loan, you must make a lump sum payment towards your loan. So what does this mean? If you have a parent that passes away, an inheritance opportunity, or a large investing win, or something that gives you a large sum of money, you can make a lump sum payment, which will change your amortization and your loan amount, but will not change the terms of your loan. The fees are also significantly less when you recast than when you refinance. Plus, if you have a low interest rate, you get to keep your low interest rate and terms. It's also important to note, not every mortgage company will allow a recast, so be sure to check with your mortgage servicing company to make sure that's an option for you. Number 2 is very simple. It is also a lump sum option. Now, it's important to note that FHA and VA loans don't allow recasting of a mortgage. So if you have either of those loan types, but you like the lump sum option, then this becomes available to you. Let's say you're a commission-based employee or a bonus-based employee that receives large chunk payments on a regular basis. You could choose to make multiple lump sum payments on an annual basis to your mortgage company that will simply pay down your principal. Now, it's not going to change your payoff schedule and stuff like recasting will, but it's certainly going to reduce the principal and the amount of time required for you to keep making those payments to pay it off. So for a lot of you out there, lump sum payments make a lot of sense because of the way you get paid. And the key to this is making sure that this fits in with your financial goals that you have for yourself and for your family. It's important to note that with some mortgage companies, you must specify when you're making principal-only payments. So be sure to check with your mortgage company and make sure you follow the rules to make sure that your extra payments are being put directly towards the principal of the loan. Okay, let's move to number 1. Drum roll, please. Number 1, refinancing your home. This is far and away the most common option, especially with interest rates being lower. Now, we are seeing interest rates rise, but certainly if you didn't get a loan within the past year or two, the rates that are current are going to be lower than what you already have. Now, refinancing offers multiple different upsides and benefits. A 30-year loan is the most common far and away amongst borrowers. That being said, most lenders offer a 15 and a 20-year term. What that does is that increases your payment per month, but decreases the amount of interest you pay because you're only paying on the loan for 15 or 20 years as opposed to the full 30-year term. The upside of a shorter term loan is interest rates are typically lower on shorter term loans than they are on the long-term loans. Let's say you're financing $250,000 on a 30-year loan at 3.75%. Your principal and interest payments will be somewhere around $1,150 a month. Using the same loan with a 20-year term, but at 3.625 interest, is going to increase your payment only to $1,450 a month, and you're going to pay off your loan 10 years faster. The best part, the interest savings on that 20-year loan would be over $65,000, and you own your home a decade earlier. Refinancing always makes a ton of sense, especially if you're going to stay in the house for 3 to 4 more years, because you create the opportunity to do 2 things. 1, if you have equity in the home that you want to pull out, or 2, if your goal is paying off your mortgage earlier, then you roll that equity into a 20-year note, and your payment might stay very well close to what it was on a 30-year term, and you're going to pay off your debt 10 years faster. What are the downsides to paying off your mortgage early? Well, there's a couple of them. 1, the stock market averages 10% per year every single year. So you could take the same money that you're going to save up and invest in paying off your home earlier and invest that in the stock market at 10%, and then you'll just have to do the math on whether or not that rate of return is equal to or better than the savings you're going to get by paying off your mortgage early. The other thing is some homeowners write off their mortgage interest on their taxes, providing them with a great tax benefit that they don't want to get rid of. And so in those cases, it may make more sense to keep your mortgage for the full 30-year term because you're receiving other benefits by having the mortgage. The other thing is having access to your capital. If you pay off your home free and clear, you're sitting on an asset, which means your net worth is tied up in a lot of that house. Now, if the market changes or crashes or home values dip or anything like that happens, now a large portion of your net worth, which is tied up in that asset, is now worth significantly less than it would be if it was in the market making 10%. For instance, 2008, if you had a paid off house in 2008 when the crash happened, well, you really didn't have much because houses weren't worth much at that time, and those people would have been better off having their money in an investment. But if you're able to do both, and you're able to set aside money to both pay off your debt faster and invest in the stock market or other things, then certainly being debt-free is always better than having debt. And so we wanted to just come to you and give you a couple options on how you might actually do that, decrease your debt load, pay off your mortgage faster, and create financial freedom for you and your family. Make sure to smash that like button, subscribe to the channel for more great content. We'll see you very soon. Have a great day.